Welcome, Dato'.
Thank you, Sakina. Assalamualaikum and very good morning to all. In fact, it is my pleasure to welcome all of you to MBSB Bank's second webinar. First of all, I wish to extend sincere apologies for our President and CEO, Dato' Seri Ahmad Zaini Osman, who is unable to be with us today. I will be delivering this keynote address on his behalf. A little bit of a beginning of this idea of having webinar. I would like to share with you, we chose today's topic of lockdowns and recovery. Where are we heading? Because we thought it voices what many of us are thinking during this period of uncertainty. In the last 1.5 years, the world and life as we normally know it have been completely upended by the COVID-19 pandemic. What began as a temporary inconvenience transformed into a frantic battle of public health against the virus, but one that many originally thought would be over by 2021. But as economies and borders continue to stay shut, the reality has now become a battle of life versus livelihoods, particularly in emerging economies such as ours. To share with you, when we start our 2021 business, we, MBSB Bank, really thought that 2021 will be a recovery mode. Our business plan really driving, using the foundations of a recovery. But unfortunately, as I mentioned earlier, the borders continue to shut, economic still very weak. So Malaysia's GDP contracted to negative 5.6 last year, making it the sharpest downturn since Asian financial crisis. After successful lockdown measures last year, this year was envisioned to be the year of recovery. Unfortunately, the country's first quarter 2021 performance was encouraging as the global recovery drove export up. However, this insidious virus has brought on the second and third wave of infections and lockdown since, again pulling the brakes on the economy. Even with the numerous government stimulus programs, the repeated rounds of nationwide lockdowns, necessary as they may be, have been economically painful for all. We, in fact, are losing up to RM 1 billion per day in MCO3. While there are pockets of growth and upside in our exports, particularly in E&E and the commodity sectors, the recovery of the country as a whole remains uneven and fragile, as long as we cannot fully reopen. From a business perspective, it has become very clear to me that the burn of any economic lockdown is disproportionately felt by SMEs and micro enterprises, given their smaller scale and limited financial resources. This is worrisome because SMEs are the nation's backbone and crucial to the long-term economic development of Malaysia. They contribute close to 40% of Malaysia's GDP and about 50% of total employment. A recent survey by the Ministry of Entrepreneurial Development and Cooperative estimated that some 580,000 businesses, or 49% of the SME sector, are at risk of failing by October this year, if they are not allowed to resume operations by then. This is surely a dire prediction, one that nobody hopes will materialize. So how do we overcome these towering challenges? Despite the grim situation that we are in at the moment, I hold on to the glimmers of hope on the horizons. First, the pace of vaccination has been picking up steadily. The government has ramped up its effort with daily vaccinations reaching close to 400,000 doses. Recent statistic that we have as at 24th July 2021, 16.5% of the population has been fully inoculated. As communicated under the National Recovery Plan, this will help to push towards reopening of the economy and with that, alleviate livelihoods at stake. Second, the government's fiscal and monetary stimulus totaling some RM 530 billion to date have been helpful lifelines for many individuals and businesses during this crisis. While the government has acknowledged its limited fiscal space, I believe we have sufficient liquidity in our domestic monetary system to further support finances if required. As for the bank itself, MBSB is also doing our part to support our clients and the business community in these trying times. We established Care Unit in July last year, 2020, which was and still chaired by our President and CEO, Datuk Seri Ahmad Zani Osman. And we have been providing and continue to provide targeted repayment assistance to our customers who have been affected by COVID-19 pandemic. We really encourage you and all of the customers to talk to us if you need financial assistance to ease your cash flow. In fact, we are ready to assist you and your business every step of the way. In the recent months, it's also heartening to see the generosity and resilience of Malaysian people and her entrepreneurial spirit. COVID-19 will likely bring about new norm, one where we must adapt and transform ourselves and our businesses if we are to survive in a rapidly changing future. I really hope that the disclosure and insights to be shared during this webinar will be helpful towards your preparation for that future. I would like to end with a quote by Ralph Waldo Emerson, who said, "We acquire the strength we have overcome." I think, in fact, the more adversity that we overcome, should we be stronger. We should become stronger at this. I wish to thank RAM for helping to organize this event for us. We have an exciting lineup today. There will also be a panel discussion, which I will be part of. My hope is that please do let us know how MBSB Bank can assist you in these challenging times. Thank you once again for taking the time to join us today. On behalf of Datuk Seri Ahmad Zani Osman, our PCEO, and the rest of our senior management team of MBSB Bank, we wish all of you a very fruitful sessions ahead. Thank you.
Thank you very much, Yang Berbahagia Datuk Nur Azam from MTIE for sharing your thoughts and setting the stage for today's webinar. So starting our first presentation, Mr. Woon Kai Jack, RAM's senior economist, and he will be covering the outlook for the Malaysian economy for the rest of this year and next. Kai Jack, over to you.
Okay, good morning, everyone. Thank you very much, Sakina, for the introduction. I'll be starting off today's series of presentation with the 2021 economic outlook. Next slide, please. So first off, as aptly described by Yang Berbahagia Datuk Nur Azam in his welcoming address, the world has indeed been thrown into disarray since the global pandemic began last year, causing massive destruction in life and livelihood, also plunging the world into a global recession. It's the last global recession has been almost 10 years ago, and unfortunately last year and maybe towards this year as well. So 1.5 years into the pandemic, countries around the world continue to fight this battle with very little wiggle room to actually spend. As we know, this balancing act is a very tough one to carry out, given the numerous resurgences of COVID-19 infections around the world over its very, very brief history. So furthermore, the emergence recently of the highly infectious Delta variant has also aggravated the health crisis, especially in the Asia as well as the Pacific region. If you can see in the news, countries like South Korea, Vietnam and Taiwan, which had actually done very, very well in containing the spread of the virus in the past, have recently succumbed to the virus, and this also led to soaring cases or tightening of restrictions in those countries. Next. The same can be said for Malaysia, where we were also forced to actually impose a return of harsh lockdown restrictions to actually battle another resurgence in virus infections at the moment. So as you can see from the left-hand side chart, the Stringency Index, which actually indicates the level of restrictiveness of government policies, rose sharply in May, coinciding with the implementation of MCO 3.0, which I have actually marked at number 4 on the chart. So this actually comes after the gradual relaxation of restrictions after MCO 2.0 in January this year. So as a result of the tough operating conditions due to the harsh lockdowns, we have actually, Malaysia's economic prospects this year has actually dimmed quite significantly. And this has also overshadowed the fairly promising nascent recovery that we see earlier this year as well. So one of the earliest indication of the impact arising from the phase 1 lockdown can already be observed from the level of population mobility during the same period. So to do that, actually, what we have done is that we have used the Google mobility data, as you can see on the right-hand side chart, as a rough proxy for general spending and economic activity, given that it captures the general population movements towards this sort of point of spending. So the level of activity will actually be a very rough gauge towards the level of spending during the same period. So you can see that in the right-hand side chart again, mobility level actually fell rather significantly during the MCO 3.0 and further fell during phase 1. So what this actually suggests is that the economic activity fell sharply as consumers actually stopped heading out to make any unnecessary spending. So the fall in economic activity even exceeds that of the level that we've seen during the MCO 2.0 period back in January this year, which I also marked at number 3 on the chart. So this actually suggests that the economic impact from phase 1 lockdown will likely exceed what was experienced earlier this year under MCO 2.0. But nonetheless, the drop in phase 1, what we have also observed is that the drop in phase 1 was not as steep as what we saw during MCO 1.0, which was marked as number 1 on the line chart that you've seen on the slides. So hence what this suggests actually, we should expect a marked decline in economic activity in June. But the silver lining would be that we should not expect the same level of contraction that we see last year, but nonetheless, it's still going to be relatively significant. Next slide, please. So moving on to the business side of the equation, we also note that the tighter restrictions also place a very huge burden on businesses as it hampers their ability to continue to produce their goods and services normally. Under phase 1, only selected essential industries and services sector can or are actually allowed to operate. And even for those that are allowed to operate, they can also only operate at a lower capacity of 60%. So this contrasts against MCO 2.0 earlier this year, where sectors are actually allowed to operate at a capacity that actually deemed optimal as long as they adhere to the strict SOPs that was in place at that time. So as captured by the PMI data on the left-hand side chart, we can see that the general level of manufacturing activity actually plummeted to a low of 39.3 points in June. So this is actually much lower than the level seen during MCO 2.0 of around 47 points. So the pressure in the sharp retreat in economic activity will also be especially felt by the more vulnerable micro, small and medium enterprises, which also tend to have less resources at hand. So if you move on to the right-hand side chart, you can see that as indicated by the latest result from the RAM Business Confidence Index, as shown, over 60% of the micro and SMEs actually cited that they expect their sales to decrease over the next 3 months, which is a steep rise in terms of pessimism against the 47% that actually cited this option during the previous survey. And the sharp rise in pessimism of smaller firms towards their sales outlook also completely offset some of the improving outlook that we saw over the past 2 consecutive quarters of our survey. So this actually hints at how the lockdown might have actually derailed the ongoing business recovery that was rather promising earlier this year. Next, please. So moving on to the labor market. The labor market, in our view, is also another key casualty from the latest lockdown measure, especially given the heavy pressure that we know businesses are actually facing. So as you can see from the top chart, prior to the latest lockdown measure, labor market has actually registered some very promising recovery, as we saw more and more people being employed, while the number of unemployed persons have also been falling month-on-month since February. However, this recovery might be at risk as the strict lockdown measures could trigger another wave of layoffs as businesses actually seek to cut operating costs during this lull period. As we have already observed some initial signs of this turning point, with the number of people actually filing for loss of employment actually rose quite significantly in June. So if you refer to the bottom chart, the number of cases that was filed to SOCSO in June was actually 50% higher than in May. So this actually suggests that the unemployment rate could have once again risen due to this lockdown. So what I can say is that this is definitely not a very good sign, as it actually signals weaker consumption demand conditions moving ahead, and will likely also compound upon the stress that businesses are already facing at the moment. Next, please. So with what has happened so far, where we live our lives under strict restrictions, I'm sure the burning question again, or the main reason why everyone is joining this webinar is that whether a return to normalcy is actually possible, or when will we ever actually see a recovery? What we can say at the moment is that given some of the promising development that we've seen recently, there's definitely still some hope for a return to normalcy. But, and a very big but, I must say that the current restrictions in place will definitely make it a very long journey and a very major hurdle for some of the businesses as a community to actually overcome. Next. So one of the key signs that the economy is actually returning to normal is the rosy global economic recovery. So if we reference both the IMF and World Bank, the global economic rebound in 2021 is actually fairly certain, as the two international organizations actually announced multiple GDP growth forecast upgrades this year. So during their last upgrade, IMF have actually upped their global GDP growth forecast by 0.5 percentage points to 6%, while World Bank has also upped it further by 1.5 percentage points to actually to 5.6%. So the upgrades are understandable given the consistent outperformance of the global economy against their initial expectation. But I think one very big caveat, or one of the things that both institutions have also acknowledged, is that for 2021, the rebound in growth will actually be largely driven by developed markets like the US and the Europe, which has already been starting to reopen, as opposed to the emerging markets like, say, the Asia as well as Malaysia or ASEAN, as the emerging markets continue to actually struggle with the economic fallout of the pandemic. Next. So how does the better global economic recovery actually benefits Malaysia? In a sense, Malaysia being a very small and open trading nation, it actually very much stands to gain from the strong recovery in global demand. We believe that the strong export performance will provide the much needed support to Malaysia's economy, while also helping to actually mitigate some of the downside pressure that we will actually see from domestic demand. As indicated by the left-hand side chart, the global trade volume, you can see that have already actually surpassed its pre-pandemic trend. So which tells us the story of that strong global demand recovery that we are seeing at the moment. The right-hand side chart, we actually plots Malaysia's export performance, also tells a very similar story, with Malaysia's exports also recovered above its pre-pandemic trend level, despite the rest of the economy remaining below the pre-pandemic level. So this highlights how the lift that the export is expected to provide towards Malaysia's export recovery this year. Next. So one particular bright spot for Malaysia's export performance has definitely been the E&E sector, or the electrical and electronic sector. Malaysia's export performance so far has been largely buoyed by the strong E&E demand since June last year. So as you can see from the dark blue bars on the chart, the sector alone actually constitutes around 40% of Malaysia's overall gross exports. And this momentum is actually also expected to continue through the rest of this year as well, given the rosy global economic recovery, as well as the semiconductor super cycle that we are seeing this year as well. So based on a recent estimate, the global semiconductor sales is actually projected to grow close to 20% this year, which is almost triple the 6.8% growth registered last year. So definitely there's a lot of room for further growth in that front. Next. So another aspect that is also pointing towards Malaysia's path of normalcy that we are heading is that also the ramping up of the national COVID-19 vaccination. So as evident by the more developed nations, which could actually afford to actually open up their economy and return to a more normal life. And those are actually largely due to their high vaccination rate. So Malaysia's rapid vaccination coverage in the past recent few months also gives us hope that Malaysia may also soon return to normal as well. So at the moment, all the states in Malaysia currently have already reached the vaccination rate threshold to actually transition into phase 2 of the National Recovery Plan. Although some of the states, as you can see from the right-hand side, remain in phase 1 as virus infections remain rather high. So they still are not meeting that particular COVID-19 case threshold at the moment. But however, once cases fall, we should also expect states, those states to actually move into the more relaxed phase 2, and this will actually provide some uplift towards 2021's economic growth. So based on the current data, as you can see, Perlis looks likely to be the first state to actually transition to phase 3, where under phase 3, all sectors are actually allowed to open, barring certain social sectors. So other than that, another promising one will be also Sarawak, which has actually the second highest vaccination rate, while also being vaccination rate currently also being under the phase 3 threshold at the moment. So this is also another prime candidate to actually join the other states for further relaxation of restrictions. So I guess if anyone's actually tuning in from the webinar from Perlis or Sarawak, perhaps you have something to actually look forward to in the near future. All said, what we can say is that it's important to actually note that Malaysia as a whole will actually only reap the benefit if all the states can actually transition into the more relaxed phase 2 and phase 3 earlier. So the rapid vaccination rollout nationwide will certainly be a very key aspect to actually look out for moving forward. Next. So until that happens, businesses will unfortunately have to continue to face very immense pressure, and will likely also have to rely on the policy support measures rolled out by the government to actually stay afloat. On that front, the government has actually rolled out 530 billion worth of stimulus to date since the start of the pandemic, with very equal emphasis on assisting both households and businesses. So on both fronts, they are also covered by the government. The most recent, if you look at the most recent permanent stimulus package, which is worth 150 billion, it is actually the second largest package since the pandemic began last year. So it only comes after the huge pre-hearting package of 260 billion that was rolled out last year at the onset of MCO 1.0. So for permanent package specifically, is actually allocated with the intention of mitigating the negative impact from the phase 1 lockdown. So you can see that the permanent package actually focuses mostly on measures that addresses the immediate cash flow needs of those that are under distress. So with the loan moratorium actually taking up the bulk of the program value. Another thing to note is also that the package also includes the much called upon wage subsidy program, as well as the special financing scheme for SMEs. So the various programs we believe will actually help to mitigate somewhat some of the downside impact of pressure, and will maybe help to some of the firms to actually sustain their operation until we reach that point of normalcy that everyone is actually looking out for. Next. So given what we have seen so far, where do we actually see Malaysia's GDP growth in 2021? So for RAM, actually currently sees a slower recovery of 3.8% in 2021, which is down from our initial expectation of 5% earlier this year. So the slower growth is actually mainly just to reflect some of the marked tightening of economic and social restrictions following the MCO 3.0 and phase 1 lockdown that we saw in the past 2 months. Also, as we have also talked about in the first few slides, we also expect the tougher operating conditions and lower consumer mobility to actually substantially weigh on the economic growth this year, and this will be mainly reflected in the slower services growth. Another point or another aspect that we are also not as rosy at the moment is on household consumption amid the weak labor market that we expect, because we expect that the unemployment rate to actually remain elevated relative to its historical trend. So private consumption is actually expected to remain sluggish on this factor. Again, nonetheless, we view manufacturing sector as the key bright spot for Malaysia. And also the pandemic will actually remain a very key risk or a very key determining factor to our forecast. So should we actually see the vaccine rollout progress being faster than expected, leading to some of the states to actually reopen and transition into the more relaxed phase 3 and 4, then that will definitely actually provide an upside to our current GDP growth projection. So on the flip side, any unanticipated delays or prolonged stay in phase 1 would actually crimp our forecast further downwards. Next slide, please. So with that, this actually brings me to my last slide today. So I would just like to round off the presentation with some concluding points. So first off, business conditions and performance is likely to remain weak in 2021. That's I think something that we can say fairly certain at the moment due to the pandemic. But while 2021 will actually not mark a return to normal, recovery is certainly on the horizon. Although it will definitely actually also take some time before we reach that point, and it will definitely also be a tough journey, especially for the businesses and some of the more vulnerable households. So as it will take some time before we reach that point of normalcy, we believe that perseverance is key, and businesses must actually be ready to weather the uneven and tight operating conditions at the moment. And to alleviate some of the ongoing pressures, maybe businesses can actually look into other avenues, or tap into the some of the government assistance that have already been rolled out to actually sustain their operation, and hopefully we can reach until that point in time of that much coveted normalcy when it actually arrives. And with that final point, this actually concludes my presentation for today. So back to you, Sakina. Thank you.
Thank you, Kaijak, for providing us the outlook on the economy. So now let's move on to the next presentation. Mr. Thong Man Wai, RAM's Head of Corporate Ratings, will now share his views on the outlook for various key Malaysian corporate sectors. Man Wai, over to you.
Thank you, Sakina, for the introduction. A very good morning to everyone. I'm Man Wai, the Head of Corporate Ratings at RAM. Today, I'll be sharing our views on quite a number of sectors, so I can't be dwelling too deeply into them. Nevertheless, I will be happy to address any questions that you may have during the panel session later. This slide gives you an overview on how we have positioned the sectors in terms of how much they have been impacted by the pandemic. On the left, we have sectors that have been most affected. They include industries that saw little to no recovery, such as the aviation, gaming, and hospitality sectors. It also includes sectors that have been severely affected by the various MCOs, such as the retail malls, and offices sectors. In the middle section, we have sectors whose fortunes have been lifted by timely and supportive measures by the government, without which these sectors would have suffered greater losses. These sectors include the construction, automotive, and residential property sectors. Oil and gas also falls into this bucket with the recovery in oil prices. Last year, as we remember, this sector was one of the most affected as oil prices plunged due to a severe demand and supply imbalance. On the right section, we have the sectors that have largely outperformed during the pandemic. Plantations are enjoying record high CPO prices this year due to tight demand-supply conditions. Glove players are still enjoying strong demand, although prices have since moderated from their peak in 2020. E&E players, like what Kaijat has alluded to, are enjoying strong export demand as people are buying more gadgets and appliances as they have been stuck at home and have had to work and study remotely. Due to the strong demand for cars and consumer durables, commodities like iron, steel, aluminium, and also copper have all risen significantly this year. Having said that, it is not all smooth sailing for these more fortunate sectors. Plantations are still grappling with the worsening worker shortages as the hiring freeze for foreign workers remain. Glove, E&E, and commodity players have all had their capacities reduced during the MCO 3.0, despite the strong order flows that they currently enjoy. I will discuss some of these sectors in detail in the coming slides. Next. Perhaps the most affected sector by the pandemic has been the aviation sector. Last year was the worst financial year in history for the aviation sector. It is estimated that the industry burned a total of $100 billion of cash last year. If it wasn't for government financial support, many carriers would have already folded since the start of the pandemic. In Malaysia, air passenger traffic plunged more than 75% in 2020. Today, due to the ongoing border and travel restrictions, passenger traffic remains 95% below 2019 levels, with international traffic being negligible at this point in time. The sharp drop in air travel has in turn severely impacted the hospitality and retail sectors. IATA forecasts that pre-pandemic passenger traffic may only be reached by 2023. So this is a very long road to recovery for the aviation sector. The bright spot has been that there has been a sharp increase in domestic travel in countries and regions that are more advanced in their vaccination rates. However, the current surge in cases worldwide due to the highly infectious Delta variant could again push back the recovery of this sector. Next, the retail mall sector was already facing an oversupply before the pandemic. Last year, we saw demand fall off due to the lower business volumes as well as footfall caused by the various travel and movement restrictions. This had resulted in the continued decline in occupancy rates nationwide. Many retailers have since pivoted online or moved to non-mall locations as consumers now prefer to shop nearer to their homes. These factors will continue to have longer-term implications on retail mall demand. During this difficult period, mall owners have been helping tenants via rental rebates, but most retailers still do not generate sufficient cash flow to cover costs. As such, many businesses have already called it quits. Most notable victims of this pandemic include the Robinsons departmental stores and also MDO cinemas. We see no end to the pressure on mall occupancy and rental rates as new malls are still expected to open over the next few years. Next. Like the retail mall sector, the office sector was also facing a worsening glut prior to this pandemic. The only difference is that demand has been holding up better for the office sector. Having said that, the office space demand is expected to remain weak due to more cautious business expansion. In addition, work from home arrangements may become a new norm after the pandemic, lowering office space requirements over the longer term. As such, we expect occupancy and rental rates to decrease as more and more buildings enter the market over the next few years. Next. In terms of residential property sector, it had experienced a significant decline in transactions during the second quarter of last year due to the MCO 1.0. However, thanks to the reinstatement of the home ownership campaign since June 2020, transactions have since bounced back strongly in the second half, even surpassing levels seen in 2019 during the previous HOC. Around 25.6 billion worth of properties had been sold under the current campaign up to February this year. Specifically, there has been very good demand for larger and landed properties, driven mainly by the increasing work from home arrangements offered by employers. Other more positive developments from the HOC reinstatement include the easing housing overhang. Meanwhile, loan moratoriums, targeted assistance, as well as EPF withdrawals have also helped ease the pressure on housing prices by helping affected borrowers hold on to their homes. With MCO 3.0, the industry is again facing headwinds, but the extension of the HOC until the end of the year could again help provide a boost when the lockdown ends. Next. Moving on to automotive. It is another sector that suffered greatly during MCO 1.0. However, the Penjana sales tax exemption boosted sales in the second half of last year, and many automakers took full advantage by launching new models aggressively. This includes the Proton, highly popular Proton X50. As a result, the sector has sold almost 530,000 units last year, just recording a small decline of 13% year-on-year. With MCO 3.0, the industry is again facing sales and production disruptions. On a positive note, many car makers entered this period with strong order backlogs. The extension of the sales tax exemption until year-end will also help provide support for the remainder of the year. Having said that, the big question that we have is whether demand will be strong next year, as the tax exemption may have already front-loaded quite a lot of sales in the last 18 months. Next. The construction sector ground to a halt during second quarter last year. Although we saw a promising improvement in the third quarter, the sector has struggled to get back to pre-pandemic productivity. This is because the frequent worksite COVID-19 outbreaks and also delays in project rollouts. We expect activity levels to be severely affected during the current MCO, affecting activity levels in the second and third quarters this year. Apart from work disruptions, contractors also face acute labor shortages due to the foreign worker hiring freeze, as well as escalating raw material prices, especially steel bars. On a positive note, the expected rollout of government projects will help support activity levels over the medium term. The government have often turned to infrastructure development to get the country out of previous economic slumps. Next. Oil plunged to historical lows last year during the height of the lockdowns globally. They have since recovered due to the strong recovery that we've seen since the start of this year, as well as continued production discipline of OPEC and its partners. It is quite likely that crude oil prices will average around $65 per barrel this year, slightly higher than our initial forecast of $60 per barrel. High oil prices will be supportive of demand for oil and gas support services. However, any revival of US shale production or the worsening demand due to the current Delta wave globally will be negative to prices. Next. The last sector I'll cover is the plantation sector. This sector has enjoyed unusually high CPO prices this year due to the tightness in global edible oils market. In Indonesia, huge volumes of CPO are being diverted to biodiesel production through their highly successful B30 program. In the US, soybean oil prices have also shot through the roof due to demand for renewable diesel or hydro-treated vegetable oil or HVO. In short, HVO is a much superior version of biodiesel and currently enjoys lucrative subsidies in the US. As a result, CPO prices have exceeded 4,000 ringgit per metric ton in the first half of this year. The very strong CPO prices will help offset the production challenges that have been caused by the worsening labor shortage. Higher seasonal output may also not be as strong this year due to unfavorable weather patterns of late. Another risk that planters face are increasing environmental, social, and governance risks. Previously, the focus was more on the environmental impact of the plantation activities. More recently, the scrutiny has shifted to labor practices. Next. I will end my session on a more positive note. According to our research, we note that larger and listed corporates on Bursa Malaysia have shown financial resilience despite the pandemic. This is also consistent with the performance of our rating portfolio, which has largely been stable. Downgrades and negative outlooks since last year were mainly from the most affected sectors like hospitality, gaming, and retail. Therefore, larger corporates will have the financial capacity to anchor the Malaysian economic recovery once the pandemic subsides. With that, I end my presentation today. Thank you.
Thank you, Manwai, for your presentation on the corporate sector. So in the next few minutes, we would like to share with you some pertinent findings from the recent RAM Business Confidence Index survey that was concluded in June 2021. Now I'd like to run a video presentation on the finding. The RAM Business Confidence Index is a quarterly survey by RAM on forward-looking business sentiments, recently conducted in May 2021, which polled 173 SMEs. While firms were optimistic prior MCO, the index nosedived to a record low of 33.2 in second quarter of 2021 after MCO 1.0 was imposed. three challenges faced by SMEs. Weak economic conditions. 83% of firms have voted it as the number one challenge. Rising costs of doing business comes in second. And regulatory issues is the third biggest challenge at 52%. More than half surveyed have cut overhead costs in the past year. Other changes include pivoting to e-commerce. About 40% said more cost-cutting is needed in the future in order to stay afloat. Over 70% of companies we surveyed needed another round of stimulus. The government has recently announced Pemulih with RM 150 billion in response to the latest lockdown. Wage subsidy and extended loan moratorium ranks high on preferred measures by SMEs who have less cash reserves than larger firms. Is there light at the end of the tunnel? Despite the tough challenges, more than 80% of businesses hope they will recover in 1 year's time. The survey results show that Malaysian SMEs are resilient, exhibiting a strong entrepreneurial spirit. With continued government and community support, we are hopeful that SMEs will be able to pull through this crisis. Okay, welcome back everyone. Before we start the panel session, I would like to remind you once again to submit your questions anytime through the Q&A box. If you wish to engage with the speakers directly. So with us today, we have two distinguished panelists, namely Yang Berbahagia Datuk Nur Azam M. Taib, Deputy Chief Executive Officer of MBSB Bank, and Mr. Foo Ngee Kee, who is a National Council member of the SME Association Malaysia and President of the Sabah SME Association. Allow me to give a brief introduction on the guest panelists today. Yang Berbahagia Datuk Nur Azam has been at the vanguard of the bank's corporate business division since joining in 2010, rising to Chief Business Officer and subsequently the Deputy Chief Executive Officer of MBSB Bank Berhad. He has more than 26 years of extensive experience in the banking and finance and in the areas of auditing, structured lending, business banking, and corporate business. Prior to MBSB, Datuk Azam was head of business banking in Bank Islam Malaysia Berhad. And we have with us Mr. Foo Ngee Kee, who co-founded the SME Association of Sabah and was elected the inaugural president in 2018. He is also the National Council member of SME Association and Malaysia, as well as the investment advisor for both Sabah China Chamber of Commerce and the Malaysia China Chamber of Commerce Sabah branch. Mr. Foo is also chairman of BIM Piaga, Kota Kinabalu. Mr. Foo is an ex-banker by profession. Now, rounding up our panel today with our two speakers, Mr. Tong Man Wai and Mr. Woon Kai Jack. The moderator for this panel session and Q&A is Ms. Julie Ng, RAM's Deputy Chief Executive Officer. Julie, over to you.
Thank you, Sakina. Hello and good morning, everyone. I hope all of you are keeping well today. Welcome to this panel session that I'll be moderating. We have 4 panelists with us here today. I'd like to welcome back Dato' Noor Azam from MBSB Bank, and also welcome Mr. Fu Ngiki to this panel, as well as my 2 other colleagues whom you had the privilege of listening to their speeches just now. Before we go on to the panel, I would like to just share that we will probably spend the first half of this panel on a few topics with our panelists. Namely, I'd like to get a bit of insights on the ground situation with SMEs and with banks, as well as talk about some recovery prospects that lies ahead of us, and also what businesses might or can do to overcome this crisis and to become stronger in the post-recovery, and to also prepare for the new normal. We also want to make this session as interactive as possible. So if you have any questions or views that you want to share with us, please feel free to drop them into the Q&A box, and we'll try to take questions as we go along in this session. All right. Okay, I think it's an understatement probably to say that this prolonged lockdown has really thrown a lot of us and the businesses into disarray in the past 1.5 years. Before we go into some of the specific topics of recovery, I'd like to get some quick insights of the ground situation from our 2 guest panelists here, starting off with Dato' Azam. Dato', we know that many firms are currently facing liquidity crunch, and many of them are probably, finding it hard to repay bank loans and also their trade creditors as well. So I'd like to ask you, maybe you could share with us what is the situation with your MBSB Bank customers. Are you seeing high opt-ins with regard to the latest round of moratoriums or even before then? Dato'?
Okay, thanks, Julia. Just to share with all the participants, on the SMEs, because probably the period that they are able to apply for more than 6 months, we only receive quite numbers of SMEs applying for Mora now. But well, like I said, it will go all the way to December. But we are not going to wait until the account become 1 month or 2 months. What we have done is that we have formed up a special dedicated teams, early care, to engage these SMEs, because of we want to make sure that before they turn into areas, we'll be able to assist them, either Mora or any form of financial assistance that fit into their business requirement.
Okay,
So,
thanks.
Yeah.
When you talk about the SMEs, are there any particular sectors that you're seeing this more of the Mora requests coming in?
Yeah, first round, March 2020, we can probably zoom into this vulnerable sector. But after that, the lockdown continues and come with the MCO3, another lockdown. So based on the numbers or even our predictions, I think the whole business chain has been affected. So the group that actually apply Mora, the businesses that actually apply Mora, some actually come from essential segment as well, because of they are essential, but their workers cannot commute.
Right.
So as a result of that, they are affected in a way. So the idea that vulnerable sectors actually affected, only the segment that's affected, not really in practice anymore right now, because I think that the whole chain of business actually affected.
Yes, I agree. I think the divide between what is essential and non-essential has already ceased to, to exist after a prolonged lockdown, right? Yeah. What about your corporate customers? Are you seeing any opt-ins for Mora?
We have done the engagement earlier, subsequent to the first round of Mora last year. So we have engaged them, understand their issues, and we have done the required R&R if need be. So this time around, they are actually obliging with the restructuring that we offered them last year, and we have yet to receive any more the request from the corporate side.
Okay, that's good to know. Yeah. So come the end of Mora by next year, what do you think will be the state of delinquency in the banking sector be like?
Well, I really wish that I have magic balls, because of as Kajek and then Manwai highlighted earlier. I mean, it's still quite fragile, right now. We really hope that there's some horizon, there's some the light at the end of the tunnel, and then we still have dreams, like some of the corporate entities says. We still have a dream, and we want to be positive. But I think the level of impairment in the FI assets will be relying very much on the length of the current national lockdown. Okay, whether slowly some of the sectors will be opened up. And then not only that, you also will be affected by the effective containment of the pandemic, the pace of the vaccinations. I think these are a few things that are really critical for us to determine what will be the level of asset deterioration, if any be. But I do believe that you guys are experts. Okay, what we forecast is that if national lockdown lengthen beyond December, I think easily 50 basis point deteriorations of assets will be observed in 2022. Probably anything above 2%. That is our opinion, Julie.
Right. But I think that I've looked at the banking sector, the capital position is quite strong, right, to withstand, to absorb all these losses.
We continuously 24/7 managing the capital positions as well as the liquidity positions.
All right. Thanks, Dato'. Now, I want to move over to the other side of the fence on the particularly the smaller companies, because we know that they have been suffering quite a fair bit. So according to, you heard from Dato' in his welcome remark that, the Ministry of Entrepreneur Development and Cooperatives have estimated some 580,000 MSMEs might go out of business by October if they can't resume operations. And we are looking at potentially about 7 million job losses at the moment. Currently, I just look at some numbers, and we don't have actual numbers on the ground, but we have about 100,000 losses from the SME sectors already, from what we know so far. So going to Mr. Fu, I'd like to get a bit more insight on how SMEs are faring in this latest round of lockdown period, and what is the situation with most of your members in the association? Mr. Fu, can you unmute yourself?
Okay, first let me thank MBSB Bank and also RAM Corporate Rating Services Berhad for inviting SME Association to be one of the panelists. And also thank you, Sakina, for the very kind introduction. Okay, coming to the how bad that SME fared, I think to sum up one word in 3-letter, BAD, bad, very bad. Okay, and 18 months is like rubbing salt into the wound. In the first MCO 1 and 2, we're already saying bad, and now I think it's worse. I think MEDEC survey actually is a very good objective survey because it's no point for us NGOs have no access to real data to do all these partial surveys. So I have also quoted MEDEC's statistics in my recent press statement. I think it's very true that many in terms of numbers, because if you look at our statistics, it's not disputed that 76% of MSME are micros. Micros are those with less than five workers and annual turnover less than 300,000. So in terms of numbers, it will be very large. And I've learned something from Manwai's presentation that the large and medium and probably mid-tier are more resilient. They have more reserves, they have better access to finance, they have better networking in terms of marketing. But for the micros, if you think about them opening a family store, okay, what sort of access would they have to financing, especially if they don't own the shop? Okay, so my observation is some positive side. I've seen my younger members who are very industrious. Okay, they are importing durians from Rob for a start to start selling durian. They never sold durian before, and I was told quite successful. 4th or 5th batches, every batch of 300 to 500 kg of Musang King were all snapped up within a few days. And we are paying very high price as usual. Sabah is crying out 78 to 85 ringgit per kilo. I think in Klang, in KL, you probably get it cheaper now. Okay, in Kelantan, they give it away for free. So Sabah always crying out, why our cost of living so high? But anyway, there are still some people rich enough to pay that kind of prices. And also there are many young people posting in the Facebook community that we have started for our members and for non-members as well, doing fashion display, live videos, selling all sorts of krepek and other utensils, and even some imported China, domestic gadgets. So I think these are the positive things that don't sit idle, I would like to say. Try to get something, although I can say that at this moment, the volume they get is not sufficient for them to call it a real business. But something better than nothing. I think that is the positive side. Then the next one is, okay, I think that's about all I have on the how bad it is. I think you have a second part to the question, right?
Yeah, Mr. Fu, I have just looked at some of the recent things done by SME associations to help their members, and I've seen a couple of webinars in the recent weeks, bringing together the industry experts and also some of your members, the associations in the respective segments, to talk about how they can actually survive this crisis. So, in your opinion, what are SMEs associations doing actually to help your members overcome, in the next 6 months, this tough period? And are some of the things that you're doing actually useful or helpful to them?
Okay, for a start, I'm glad to say that our SME Association Malaysia has been helping SMEs all along as a medium to facilitate the interaction between government and SMEs. Okay, for more so during this pandemic, many, whether members or non-members, actually reach out to our SME association to help them to get the meaty letter for them to operate during the MCOs for essentials. There a lot of confusion. So naturally, because of the press statements made by our national president, Datuk Michael Kang, many of them naturally reach out to our association to help. And I think our association have national president and some vice president actually went personally, despite all the COVID, to MITI and try to work out for them and sort out all the glitches, right? So that is one part. Secondly, also we help to disseminate information to SMEs. When government come out with all the penjana, permekasa, permulai, don't talk about the micros. Even for me, sometimes it's hard to grab all the various aspects of the aids, because SME is a very wide sector. It's not just one particular sector like manufacturing. We covers all sectors from a hairdresser to the machikia alongside selling krepek. So as a result, we need to spend a lot of time to understand each industry's aids offered by the government. So that's another part of objective. And third one, we have also been providing consultation services, in particular relating to all the SOPs that sometimes relax, sometimes tighten. So when they are in doubt, they don't want to be fined. So who do they turn to? They turn to our SME Association Malaysia to get a clearer answer. And not only that, our national president is well connected with all the various ministries. He will get the official SOPs very quickly. And the next instant he shared, whole Malaysian SME branches gets the information. And we'll share among our members. So not only that we get this information quick, but it's also reliable. Many fake news are around saying that you can do that, do this, until that the SMEs are a bit cautious that whether you say allow dine-in, is this true or not? Sometimes we also were caught by all these other types of fake news which we cannot verify directly with the horse's mouth. So in this, and also the financing side, moratorium, repayment assistance. I think I've also been in touch with Bank Negara Malaysia. I'm sure SME Malaysia National Council also in touch with Bank Negara to cry out for moratorium to be extended. And I'm glad that in the Pemulai or this round, the government has responded to our cries for help. And not only responded, I have to compliment Bank Negara. for pushing the banks, sorry, Datuk, not meant for MBSB. I know you've been very kind, but there are some commercial banks are not so kind, most of them. And I myself can speak from experience that they took 4 months and doesn't give you an answer, yes or no. So I came out a press statement. I said, you don't apply first aid in out of time, you know. You give me the first aid after 30 minutes, I'm dead already. No use. So please give it time. Even you want to reject my loan, please tell me early. Okay, then I can maybe go around, look for along or look for some other means to get through my businesses. The worst is sitting in anxiously waiting for an answer to get the loan or not to get the loan. If I get a loan, what am I going to do? If I don't get a loan, what am I going to do, right? So have a clear answer. So as a result, this last round, very smooth, okay? Just bank send to us A or B. You want 66 months, 100% moratorium, or you want 50% repayment. And then when we reply, they even use AI, very good. SMS comes, your application has been approved. That's the thing that I think I have to compliment the government for doing. And it's really what we need to put this behind us so that we can focus on our business, right? Knowing that we don't have to be receiving letters of demand and all this is a great relief. I think that basically there are a lot more. I think I won't take up too much time. Many press statements have been made that we highlight some oversights by government.
Okay, thank you, Mr. Fu. Dato, any feedback from on that note?
Yeah, I mean, to all, I think bank and businesses, we are partners, you know. I mean, if a bank try to stand tall with our policies and procedures, and then not actually care or aware of the needs of the SMEs, ultimately, this portfolio will bring us down. So I always urge my team that please understand and what you call it, aware of needs and requirement by the SMEs, because of this is actually bread and butter that we are driving right now, most of the banks. I think I welcome what Mr. Fu mentioned earlier, that the bank need to be proactive, because we are in this together. It's not that if the bank says that I don't care, you just go ahead and doing your business. If you cannot pay, that's your problem. No, it's not. Because we, at the very beginning, when we originate the relationships, we already understand that we are together in this journey.
All right. That brings me to the second topic of discussion that I would like to bring up with two of you gentlemen regarding the qualities of firms that can survive better in a pandemic. I quote a World Bank recent study that they found that there are some qualities of firms that enabled them to survive better in a pandemic, or actually to also make less use of government support during this time. And some of these traits are better access to finance. They have also stronger or longer relationships with important stakeholders like the bankers or their trade creditors. And also some of these firms also had greater organizational flexibility. Now, maybe continuing with Dato', we know that access to finance has always been an issue with smaller companies. I think you mentioned earlier that you are always supporting the retail and the SMEs in any way other than Mora. So maybe could you elaborate a bit more about how you're supporting this segment of people besides the Mora?
Okay. During this turbulence, I think besides banks, especially government, have came up with various assistance schemes. Various, I think a lot. Every now and then, there's actually a package that's actually introduced by our government, and then a channel up through the banks. I think definitely liquidity support, funding availabilities is very important. But what more that the bank can do, like us, is that providing effective and then correct information to the SMEs. Actually, this is what we are doing right now. I mean, the SMEs, you can liaise with the banks, asking of all the schemes that the authorities have already offered. But most importantly is that you should get the right information, right, that what's happening out there in the market, whether the market actually revived, what percentage that they revive, and all this. So I think that are the added values that we try to provide to SMEs beside the financial assistance itself.
Do you see a need for a more holistic or a differentiated approach to financing for smaller companies versus the big ones?
Definitely, Julie, definitely. Because of, like Mr. Fu said, there is already 18 months, Mr. Fu. We cannot expect this group of customers showing flying colors in their audited accounts or even their bank statements. So what approach that we take is that we really wanted to see their future business model, and how does the future cash flow will be validated. And this will be the key areas for us to assist them moving forward, not so much of the traditional way of appraising credit by looking at their audited accounts, how active their current account. Of course, the last 18 months, we will not be able to see that. So in order to assist SMEs or even some mid-tier SMEs, we really need to look at their business model, validate their cash flow, what will be the potential cash flow coming in, and then what assumptions they're actually using. So I think this is actually a more holistic, differentiated method that I think the bank will be embarked on. And I think the first one will be MBSB Bank.
That's good to know, Dato'. As in some of the, I know that financials is still cash flows and all that business model still very important for consideration. But are there any other soft factors, because I think we have a number of your customers here as well. What do you consider, like some of the soft factors of an entrepreneur, for example, that you would want to see in a company before you consider for the credit?
I think the first consideration is actually when we engage these group of customers, we really want to understand, how this pandemic really affect them. Because of, in general, Julie and participants, what we receive is that we got hit very bad. We got hit. We cannot sell. We cannot. So we really want to define, whether prior to pandemic, are they doing okay or not with that business model? And then the pandemic really hits them one way or another. We want to know the specific because the next step that we want to understand is that how are they managing their present business or how are they adapting themselves in the pandemic environment. In many ways, I think Manwai highlighted earlier, whether they are going to go on e-commerce, how they manage their human capital costs, operating costs, how they reach their customers in the new business model. Because all this will actually convince us that the new business model, the new adaptations will become a more sustainable business model. This is actually a few areas that we are looking at right now because of, like I highlighted earlier, we cannot rely on the historical data anymore. Environment change, new norms come into picture right now. Julie? I hope that answer.
Yeah, that does. Thanks, Dato'. I was planning to ask Mr. Fu, regarding some of these qualities, whether you see some of these qualities in terms of greater organizational flexibility and having stronger relationship with bankers and with trade creditors, whether they are apparent in SMEs, or among your members or not, or otherwise, what is the greatest challenge actually in terms of surviving through the crisis?
Okay, thank you, moderator. First thing, thank you, Dr. Noor, for your perception. I wish more bankers share your points of view, so then we'll have less difficulties accessing bank credits. Okay. I think on the qualities, basically the large corp, mid-tier, and medium, some medium may meet those qualities. But for many mediums and small, especially micro, I don't think they will meet those three criteria. Even their cash reserves are very minimal because the profitability is not high for all these micros. They don't have much savings from getting a very good profit year on year. Most of them are a means of livelihood. Many may not be able to seek employment, so they start a business, okay, to earn some money to keep themselves alive and their family members. Some even have their children helping them in the store to save on labor costs, okay, even during the normal times. So can you imagine now, Having said that, I think the greatest challenge, as what the two panelists have shared, are the lockdowns. You see, when you lock down, it's not only the business cannot be operated, even those who can operate like restaurants, during the time when Sabah experiencing very serious MCO lockdown after the state election, our numbers ran way high. I think that time high is nothing by today's standard. Only 1,000 plus is very high at the time because we are dealing with hundreds only. So the stores that were open, there was a survey by a press to say that in the very popular, kedai kopi, only 2 or 3 people went. And take away also very little because there was some psychological panic that, virus is everywhere. Like what the surveys showed, don't go out if you have to, or order food to be delivered. Okay, so these traditional stores have not transformed to do e-delivery yet. Now, those who do e-delivery are some new entrepreneurs. They're trying to make some money. So they came up with this idea, generally are the younger generation. So if we don't really address this lockdown properly, like what Datuk Noor said, also your bad loans depending on how long we exit this lockdown under phase 1, phase 2, right? If we don't be more aggressive to put more weightage on saving livelihood and continue to focus on saving lives, I think in the end, people will still be around, maybe a certain percentage will suffer death, but many will be suffering a different kind of problem. Already mental issues coming up and maybe broken homes, right? And then maybe if many workers are unemployed, like up to 7 million, I hope not, there might even be riot in our streets. See, now we are lucky that generally Malaysians are very generous-hearted. A lot of food banks also been set up in Sabah. These food banks are, to me, a headache, a panacea for a temporary measure. Nobody can continue to provide food bank in an indefinite time period, right? So this is why I think we are in a very critical stage. Government really have to look at it. I did recently make a press call as far as those states like Sabah with 500 cases and below. I think the government should adopt a more liberal, more aggressive sort of SOPs to allow more sectors to open. I think the table should be turned the other way around. Why shouldn't I allow them to open? If I allow you to open, it's likely that the COVID cases will run high. Okay, then you should not open. Negative list, crowded places, confined places, all this. But taking an example of a family store, okay, what's the difference between a family store selling non-essential goods, right? Renting a shop house with 1,000 over square feet compared to the neighbors selling pharmaceutical products? Is there any difference in terms of the risk of spreading the COVID? I argue there is none. Okay, the same SOP, customer cannot go into the shop. They come in front of the shop. Usually they are the regular customers. I want this, I want that, okay? So you bring the items to the front. If confirmed, they pay you and then they go back. If not, then you go and change the next item for them. So this has been practiced in pharmaceutical shops. So, and I think the 18 months is a long enough period to say that such modes of businesses are not the cause of the daily cases going up, right? And I'm sure there are more sectors also. I'm not sitting in the COVID center, but I think the government should really focus and start looking at which one I should not allow to open. Okay, that way, I think we may not save everybody. We will save a lot of the micros that are not the cause of the spread of the high daily cases, right? So if we don't focus on this, and I also ask for indicators, not just once in a while, MIDEC survey the indicators. There should be indicators on a regular basis to tell us, oh, this month, how many collapsed already, how many closed. So I think then the policymakers will be shaken up to say, hey, if we are too tight on the SOPs, we don't take a bit of risk, more people will die on the other hand than in the hospital beds, So this is something that I think if you don't have indicators, it's very easy to be out of sight, out of mind. And then all the policies tend to be skewed towards saving lives. There's nothing wrong with saving life. But now we are talking about two types of lives. Through failure of livelihoods, there's also life going to be lost, right? And that is very uncontrollable. Okay, COVID nowadays with vaccination, I think easier. Sorry, moderator. I think the greatest challenge still comes back to that. and whether the government can give aids or not is less important now, and also financing. Because if we are going under, okay, the aids only represent 20-30% of our cost. I can't even come up with 50% of the cost. So you give me another 20-30%, I still can't discharge my liabilities. Plus also more loans will only add to the burden. At the end, when I collapse, I will have more debt to pay. So really now the focus should be on allowing more businesses to resume and get the normal revenue that they deserve to get and move their stocks.
Yeah,
those are my comments.
yeah, thanks, Mr. Fu. I think our national recovery plan is addressing that, and I think, yeah, of course, they are tweaking it as they go along, but hopefully we will get there by the third or the fourth quarter of this year. Moving on to, I think my two colleagues have been keeping very quiet here. I'd like to move to Man Wai to talk about some rating movements in terms of, I think during bad times and recessions, of course, we see more rating downgrades, and that's to be expected. But besides financial reserves, what other qualities of firms, would lend itself to buffering, or to increasing what we call a rating headroom, so to speak, to avoid, further downgrades for a company, for example?
Thanks, Julie. I think based on our experience last year, I think the rating downgrades or negative outlooks have been more or less in line with our initial expectation. It is a far cry from the experience that we had during the Asian financial crisis, where I think the rating actions were a lot more severe and there were a lot more defaults. Based on some of the traits that you mentioned earlier, I think I see that in a lot of companies that we cover. Those traits actually allow these companies to respond more quickly to the pandemic. In fact, we see a lot of companies being very ruthless in terms of their response. I think in terms of, especially in terms of cost management and also liquidity preservation. So most corporates would have seen second quarter results coming in very bad. But due to the very proactive measures that have been taken by them, we see a strong recovery in the subsequent quarters. So with a lower cost base, a lot of these companies should be able to return to pre-pandemic profitability, even at lower than previous peak revenue levels. This is because they have already reduced a lot of the necessary costs and are primed to take advantage of the recovery once the vaccination hits our targets.
All right. Thanks, Man Wai. I would like to move on to our third topic of discussion here, and that is relating to how does a post-COVID economy look like? I think it's too soon for most of us to imagine recovery right now, especially when we are still ramping up our vaccination rate and the restrictions are still in place. But in the developed world, such as in the US and Europe especially, we are already seeing economic recovery gaining fast traction. Now, The Economist publication pointed out 3 fault lines that lie beneath the surface of a global recovery in its recent study. And I shall quote you the 3 of them. The first divides what they call the JAPs from the JAP nots, meaning that only those countries receiving or getting vaccinations into arms will be able to tame COVID and recover much faster. And so I think we're already seeing that in many parts of the developed world, whereby they're already meeting more than 50% of their population being fully vaccinated. So that will also create repercussion on the emerging market today. The second runs between demand and supply, including bottlenecks and imbalances as economies open up. So I think some economies are opening up and they will start, the consumers will start spending, but others are still locked down. So you will have some of these imbalances as demand may exceed supply, or the broken supply chain can cope with the demand. So again, this is a lot of repercussion on a small and open economy like Malaysia. The last is over the withdrawal of stimulus. We know that rich world central banks have pumped in more than 10 trillion. In fact, I think the figure is $7.5 trillion worth of assets into the system. And at some point, they will need to be reversed. I think we are already seeing some of that happening in the US, whereby they are already tempering, the need to hold down their interest rates. So the question is, how do these fault lines interact for Malaysia, and what impact does it have on our future as consumers and businesses? Maybe I'll move over to Kajek first, in terms of what are the repercussions that you see in terms of a recovery in the West versus the impact on emerging markets like Asia in terms of the risk of capital outflows and also Forex. As we know that, when interest rates start inching up in the US and Malaysian interest rates always follow quite closely, what repercussion does it have on these financial flows?
Thank you for the question. So I think definitely, like you mentioned, it seems likely that advanced economies are actually planning ahead in terms of moving towards the interest rate normalization, as they are already on the sort of a recovery mode at the moment. So I think, as you mentioned also, I think interest rates in the emerging markets will likely also have to follow suit when this happens. But I think one thing to also note that is that in terms of interest rate normalization in the advanced market, it might not actually start as soon as we would imagine, given that I think specifically if you look at just the US Federal Reserve, their recent interest rate forecast is for an interest rate hike in 2023. So we still have about 2 years more to go before we reach that point of interest rate hike. And I think, if we look specifically into Malaysia, I think Malaysia still does have time until that point when it actually happens. So, but I think at the moment, Bank Negara actually remains rather comfortable with leaving it at the current level this year, at least for this year, as we are still continue on this economic recovery. Maybe once the economic recovery is on track, then they might actually start to raise rates. But I think in terms of raising rate timeline, Malaysia will likely, or emerging market as a whole, will likely be ahead of the US, given the longer timeline in terms of the start of the interest rate normalization in the US, which is at about 2023. So maybe in the emerging market, we might see late 2022 or even early 2023, which would be likely earlier than what is in the US. Yeah.
Okay. I think I see a question previously on the Q&A regarding the direction of Bank Negara's policy interest rates. Where do you see that going in the next year, actually?
So for if I start with just this year, I think Bank Negara definitely, not to say definitely, Bank Negara, we view that Bank Negara will likely actually hold the OPI unchanged at 1.75% through the rest of this year. So I think, like I mentioned earlier, we believe that the economic agenda remains the key thing that's on Bank Negara's mind at the moment. So just to ensure that Malaysia's economic recovery is actually on track and fairly stable before we actually go into that conversation of whether when will we actually start any interest rate hikes. But in terms of next year, we might actually at the moment see some sort of interest rate hike maybe towards the second half of next year, given if we actually the National Recovery Plan progress as expected and we see actually some form of very strong recovery or rebound in the first half of 2022, then we might actually see the interest rate hike starting towards the second half of 2022. So I think we might actually see some form of interest rate normalization if we look into next year. Yeah. But that will actually also really depends on how strong the recovery would be and where we actually start that form of rebound going into next year. So the timeline is actually very sensitive to that. Yeah.
Okay. I think, maybe just to throw you a curveball as well. I know you haven't probably released the next year's GDP forecast, but I presume that next year's forecast will be better than the 3.8% this year?
I think definitely next year will definitely be better, especially given how, because we always talk about, if you look at year-on-year growth, this year is actually originally, before the resurgence in virus, is originally expected to be about 7%, and that is already a relatively healthy growth. So given how we are actually continuing to be performing below our potential in 2021, likely 2022 will also be a relatively high number. The exact number, I've not actually worked it out yet, but I would at least expect around 5 to 6% or above. Well, also, again, depending on how the pandemic actually pans out and how we actually progressing in terms of the national recovery going into 2022. Yeah.
When do you think we will ever get back to that 6-7% growth?
It could be as early as 2022, given depending on how strong the rebound is. But I would expect the next year will likely be definitely the recovery year, and 2023 will likely be a more normal years in terms of GDP growth. But whether we would actually return back to the pre-pandemic trend level, I think I plotted that the export chart where exports have already reached back to the previous pre-pandemic trend level. But I think in terms of GDP, the trend level might take a few years to actually reach back. And, so at the moment, 2020 looks rather good. 2023 might also continue on to that pace of recovery. However, whether we will return back to normal, it might actually take a few years more before we reach that point.
Before I move to Manwai to talk about some bottlenecks in the economy and regarding some of the sectors that are constrained by these bottlenecks, I see some raised hand in the panel. Sakina, can you unmute someone?
Okay, we have Cik Muhammad Hairi Basri. Would you like to speak to the panelists and ask your question? You may unmute your microphone.
Okay.
Hello, Cik Muhammad Hairi.
Sorry.
Oh, Cik Hairi, would you like to ask the question or would you like to reserve it later? Okay, we'll move on to the next hand raise, Mr. Alex. Would you like to give your questions to the panel? He has also magically disappeared. Okay, I think we will, oh wait, he's back. Okay, hi, Mr. Alex?
Yeah, good morning. Here is Alexis actually.
Alexis, okay, sorry.
Good morning to all hosts, gentlemen, ladies.
Good morning.
Great. Are you following my voice clearly?
Yes. Please, if you have any question.
Yes. Okay. Today is basically from the focus on the subjects of economic overall, our relationship between SME and government's policies. But from a point of view, as SME operator, I myself running a homestay, the F&B small business in JB. Since the MCO, my business is going to be from bad to worse, and now it's on the stage of bankruptcy. So overall, I would like to, from side of influence, we can see not only from my point, most of our SME we in a stage of very helpless because our government policy on the implementing of the MCO is not consistent. We don't see any get into a very simple point of view. We don't see any clearly cut and very consistent.
Okay, I think we lost him there, but thank you very much, Mr. Alexis, and we empathize with you with the situation that I think a lot of other SMEs are also facing. I think, I'm not sure what the question was, but would any of the panelists like to give an opinion? Or I think it is tough times, and some of the SOPs and some of the measures could have been implemented better, I think, and I think they are tweaking it, and they are learning as they go along. But I think some businesses are indeed facing a lot of pressure. Maybe for those businesses, they should get in touch with the associations, such as Mr. Fu's Sabah chapter, if you're in Sabah, to get some help on how to access some of this financing or aid that is available. I think there is a lot of financial aid out there. It's just that maybe it is not as fast forthcoming, as we like it to be, and also. It is a bit hard to access if you don't know the regulations and the documentation and the paperwork. So hopefully, you can reach out to some of these channels, even to the bankers as well, friendly bankers like MBSB. I think they're prepared to help as well to alleviate any liquidity crunch that you may be facing at the moment.
Julie, we have a Johor branch, SMB Johor. This is from Johor. You can reach out to the SME Johor South.
Okay, yeah. Thanks, Mr. Foo. Dato', anything to share?
Well, I think you put it right that this type of crunch requires all parties assistance. For example, that Alexis are running what is it just now?
Homestay.
Homestay. We have some customers, that they convert their homestays to others. For example, some of our customers in hotels, they convert their hotels. It's a bit funny to hear that they convert into a swab test center, swab test center. So
Swab
as long as this is what we call it, we need to move forward. Okay, we cannot cry over the spoiled milk, and then of course it's very difficult to do it alone. We need to engage association like Mr. Fu said just now, and engage some of the financial institutions so that they will be able to access some of the schemes or even the financial assistance provided by the government through the bank.
Right. Thanks, Dato'. Okay. To continue with Manwai, I think I'd like to talk about what are some of the sectors that are more vulnerable to some of these supply and bottlenecks that we are seeing happening, and what kind of businesses might be facing a lot of this margin squeeze from, say, a rise in the raw material prices.
Yeah, I think prior to this MCO, we are really seeing some tightness in terms of some major raw materials. For example, I think the automotive sector has faced a semiconductor shortage, which still remains unresolved. In terms of the shortage of commodities, we have also seen prices being pushed up. So a lot of manufacturers are struggling to pass on the additional costs to their customers. And of course, with this pandemic, with the operating hours or capacity being severely reduced, they're also unable to supply according to the demand for the products. And this will eventually also hit the retail sector. They may be allowed to open, but at the same time, they may not have the stock to actually sell when they open. So these are some of the sectors that will be impacted by the supply-demand imbalances. But having said that, I think we have gone through this before. In MCO 1.0, I think back at the time, the situation was even more severe. Fast forward to today, I think a lot of businesses have adapted to the reality that supply chains could be disrupted. So they have been building up some buffer stock to be able to navigate through periods where supply chains could be disrupted. So these are some of the ways players have in the respective sectors have been trying to navigate through this uncertainty.
Thanks, Manwai. Sakina tells me there's another hand raised. So could you unmute the person, and could you, Mr. Alex Tan, could you ask your question quickly, please?
Okay, thank you. So panel, my question is that inflation is going to catch up because of prices moving up. And how does it relate to Bank Negara to hold the rate for next year? How would it impact the business community as a whole?
Okay. Thanks, Mr. Alex. I believe Kai Jack can answer that.
Yeah, so I think like you mentioned, inflation have actually already risen this year. But if you look at just the CPI inflation, that is actually largely due to the rise in oil prices. So because of the rise in Brent prices, your raw 95 and raw 97 prices and diesel prices also have to be adjusted upwards accordingly. But I think at the moment, we have actually already reached the peak of where inflation will likely be at least for this year, given the current price ceiling that is in place. So any increase in terms of Brent prices will actually not be passed through into the pump prices that we see at the moment. So I think at the moment we have our CPI inflation forecast for this year at about 2.7%, which is a relatively, I wouldn't say very disruptive level that will actually push Bank Negara to actually increase interest rates this year. But I think your question was more for next year. I think definitely for next year, if the price ceiling continues to be in place, next year we will likely not see any further increase in terms of inflation for CPI, and we'll likely usually trend around the current long-term trend rate of about 2 to 3%, barring any additional shocks to the consumer prices. And I think also, like Mawai also mentioned, we also observed some increase in inflation towards some of the commodities side of things, which did materialize in terms of the higher or the spike in terms of the producer price index, which tracks the prices that are paid by the producers. However, this sort of increase in terms of PPI pressure did not actually materialize in terms of CPI pressure. This could be attributed to some of the pressures or some of the factors mentioned by Manwai earlier, like say the manufacturers not actually being not actually trying to pass on the costs on fear that this might actually reduce some of the sales volume that they are actually experiencing at the moment. So I think inflation risk remains rather benign, at least for this year and next year. So I think that would not be actually a key trigger for Bank Negara to actually raise rates for the coming, or at least in the near to medium term.
Thanks, Ajay. I hope that answers your question, Mr. Tan. I'd like to move on to the last topic of today, because I'm also mindful of the time. It's 11:57, so I'd like to end just after 12 if we can, so that we can release you to lunch. The last topic is on Malaysia's recovery and competitiveness prospects in the new normal. I think the pandemic has thrown up quite a number of positives that we can take away and perhaps help us to re-engineer ourselves for a better tomorrow. Some of the I think the positives that have been thrown up, I think the community resilience, as we are seeing with our frontliners and some of our local communities as well. So I think we express our utmost gratitude to all these people who are helping us survive this pandemic. It has also thrown up the increased awareness for social and environmental protection in terms of ESG and all that. We need to protect our environment, our earth, so that we don't run out of buffers to grow in the future. The other thing is, of course, the global collaboration on vaccines. I think we've seen fantastic work on that front. But lastly, and not least, the acceleration of digital transformation has been pushed to the forefront because of this pandemic. As a perfect example is here today, we are doing this webinar instead of what we normally do in a face-to-face meeting. Now, I think there has been a lot of talk about how Malaysia can catch up and also, recover from this pandemic and achieve better or even match the growth of the pre-pandemic years. And I think there's been a lot of talk that we need to undertake deep structural changes to some of the fundamental flaws that we have in the economy, and in order to move up the productivity and the value chain. The government is fully aware of this, and I think they've come up with many recent blueprints. For example, the Malaysian Digital Economy Blueprint, Jendela, which is worth 21 billion. And other things like National Fiberization Plan, which is for 5G, and that's worth 15 billion. And also the National Policy on Science, Technology and Innovation for the next 10 years. And that is to keep up with innovation for our younger generation. Now, maybe I'll start off with Mr. Fu first in terms of the digital economy blueprint, especially for SMEs, which are expected to benefit some 875,000 SMEs and 5,000 startups in terms of the digital grant. What challenges and gaps do you see SMEs facing in their digital transformation journey? What is the state of readiness right now?
Okay, thank you. First thing, I think definitely the digitalization is the way forward, especially for SMEs. Because when you are small, you have digitalization, you can reach out across borders, okay, which used to be only for multinationals. We have the big capital structure to do that. And also advertisement costs drop because you don't need to print hard copies, which are very costly, with especially color print. Now you just do some artwork, and then you can viral to across nations, so to say. So I would think that the only challenges is that the internet access and the speed has not been fast enough. Okay, while in the main city centers that might have been addressed, because from the telco's point of view, there is density for them to make a good profit now. But the challenges for Malaysia is that we are all very scattered across a big landmass. So those areas where the density is low, how the government going to address this They may not make as much money, but the infrastructure cost of pulling the cable, the broadband is very costly. Okay, whether we should use satellite instead of cable, all these I hope can be addressed quickly. So for us SME, we welcome this internet access definitely.
Okay.
And then the other thing is many of the micros, especially not in the city area, are lack of familiarization. So a bit of hand holding needs to be done. And some of them may not have seen the benefits. But I have shared with you earlier how a young entrepreneur with no knowledge of selling durians can use internet to bring the durian Musang King from Raub to KK and then manage to get customers all by remote. No shopfront. It's operating from one of the warehouse only. So I think like I want to add on to just now, Mr. Alex, operating a F&B and this homestay. Don't think of doing homestay. Maybe what you should do, use your time to do something like that. If you have a family member or close friend supplying durian or fruits, try to do this e-marketing. That will give you some revenue while waiting for the market to return. Another thing also, just now I thought of it, is that there are some civil servants that may be transferred to Johor. I don't know where your location is. Offer them cheap rental, instead of renting, a house, just take the room, give a very cheap one. So you have some revenue. These are some of the things that I can offer. So the other thing is a state of readiness. I think definitely, generally, I think we speak about those SMEs that are not in the urban area. They are in early adoption stage. Okay? And Sabah, of course, worse because even more diverse the population, and also the areas are more spread out. Okay, but definitely, I think one thing I like to congratulate is the other state government should follow. Sabah government has started e-commerce platform called GoNet app. Okay, this enable all Sabah SME with Sabah produce only products can list their products into their website, and they don't need to do pay money to set up their own web store or do any promotion. And of course, this DIDR part of MID is also actively helping them to get halal certification, all this. So we welcome any state governments for the SMEs in their states to help them hold hands for the micros to get them on board. I think that's important. Okay. Otherwise, the plan remains a plan. It doesn't get executed.
Okay. Thanks, Mr. Fu, for that. I'd like to move quickly to Datuk in terms of the potential or the pros and cons of digitalization to the banking industry. We know that it is also disrupting the banking industry, and many seem to think that fintechs and some of the newer digital banks are able to better serve the smaller segments like the SME segments, given their low cost, their low economic unit business model. Now, do you see this disruption risk for MBSB? And also, can traditional banks effectively serve this segment?
Thanks, Jolie. We don't think, or even we don't see that the digitalization as a disruption to the banking industry. We don't think so. Because I think, in fact, digitalization is a key to the traditional banks moving towards technology-based banking. The environment changed, the bank need to adapt to the changes. Because of ultimately, customers can do banking without a bank. So this is actually something that we believe in. And as such, we do believe that we'll be able to serve this SMEs market better via digitalizations. And then in addition to that, the agenda of financial inclusions also ensure that we'll be able to serve this group of customers effectively.
Okay. Thanks, Dato'. I think going to the Q&A box, I see some questions regarding this topic as well. One of them, I think you may have already answered. What is the MBSB's strategies in terms of getting back on track amidst this pandemic? So I think digitalization may have,
Definitely. We prepared 3 phases. We prepared ourselves in 3 phases because of we really thought that 2020 is going to be at the very beginning of 2020. We thought that the economy is actually going to go up high, until March. So as such, we come up with another strategy. We call it navigating through pandemic, where we want to ensure that we preserve our existing asset, so that in a layman terms, meaning that the customers that is already with us, we want to make sure that we give them a full assistance so that they will not continue deteriorating, or even they'll be able to maneuver through this turbulence. That's one strategy. Second strategy is that, of course, digitalizations. We know that face-to-face is near to impossible. I might be able to recognize you, Julie, but we have never met in person.
We have never met.
So same goes with the customer, we will be able to establish relationships, even though physically we will not be able to see each other in physical. So digitalization is actually our second pillar. And then the third pillar is that we're still looking at what are the niche market that available out there. With our digitalization's roadmap, we'll be able to tap them. So there's a three pillar: preserving, optimizing what we have, and then exploring a new market through digitalization. So I think it concur with our strategy that digitalization in banking is no longer something that actually accessories. It's a must now.
I think it's the same with us as well. Over at RAM, I think we are adopting very flexible methods of working. All of us are working from home today. So yeah, it's all work from home and it's all remote, and we have digitalized almost 80-90% of our work process already. So that enables us to continue serving our customers uninterrupted.
Exactly.
I see a question here that Dato', you may want to take. The question is, how can financial institutions assist a firm of solicitors or any professional firms in general, as they do not fall within the scope of SME due to non-registration with the ROC and also facing the brunt of the pandemic?
In fact, before I come to the assistant, I think, we liaise with a long list of solicitors, meaning we call it a support system within the banking. We really hope that the lockdown will be uplifted soon, because of there's a lot of transactions that cannot be done, because of certain authorities closed down, or even maintaining a minimum operational percentage. So that's the first one. We hope that the lockdown will be uplifted soon. Second is that what we have done at our end is that we are going to, we know that these are the support system that's actually critical to the bank. So what we are going to do is that we are going to appraise solicitors, valuers, for example, because they definitely will have a future potential business. So we are going to extend financial assistance in the, by giving some overdraft in conventional way, or even cash line for them to revive their existing business when the lockdown is actually opened up. So these are the various schemes that we're preparing to offer our panel solicitors or even the valuers and some other support team.
Okay, that's good to know, Dato'.
Moderator, actually, to be SME qualification, need not only register with SSM. Even those with local council licenses, like a normal sole proprietor, are also eligible. So I believe professional firms like lawyers are also SME because they only need the practicing cert, if I'm not mistaken. But can double check with the SME Corp for the definition.
Okay.
So that they will be able to get all the benefits that are accorded to SMEs.
Okay. One more question. You may or may not want to take it, but this question is about bank only provide loan if there is a property as collateral. This is very old school of financing. So I'm not sure if this applies.
Just a simple answer. I don't think that applies in the present environment anymore. When the digital banks are actually moving towards trend credit, meaning that they are appraising the trend of the transactions rather than the credit itself. I think collateralized financing, well, in one way or another, but I think most of the banks have moved away from totally collateralized financing.
Right. Okay, thanks, Dato. Moving on to, maybe I'll just end this with Manwai in terms of the topic here. Because of all these changes, do you see a fundamental shift in the way corporate businesses will operate in the new normal?
Yeah, I think given the challenges and how the businesses have adapted to the new norm, I don't see the return to how business has been done in the past. For example, I think we have spoken a lot about how retail have pivoted online, and we have also talked about how businesses have utilized digitalization to actually enhance their business efficiency. I think the one big lesson from this pandemic is that we are too overly reliant on foreign labor, and there's one area that I think players in the construction and manufacturing sector, or even plantation sector, will need to be mindful of going forward in terms of investing in technology, be it automation or mechanization, to reduce this reliance on foreign labor. And another point is that increasingly foreign labor is also attracting a lot of bad attention from NGOs, and it's not looked at favorably on a sustainability perspective.
Right, thanks, Manwai. I'd just like to share with you, as part of my closing, a recent research done by IMF on the disparity that has been thrown up by this pandemic on rich world and poor nations. In terms of, to quote some numbers, in terms of job losses that will just exhibit how this disparity will grow over time. In terms of what is emerging Asia has to lose in terms of the output, they estimate that at 7% of output will be lost come by 2024. As opposed to the world, the entire world, which is only losing like minus 2.8%. And in contrast to the US, which is the only country that will stand to gain at 0.5% output improvement. So I think, if we don't do anything, this disparity between the rich and the poor will only grow over time. And one of the recommendations for reforms is the growth-oriented reforms that we need to undertake, targeting both the, basically more of the supply side to correct some of these structural imbalances in our economy so that we can move up the productivity chain and the innovation ladder in order to catch up with some of these economies and also to hopefully narrow some of this gap. So I think it is pertinent that the new normal will include things like digitalization, automation, industry 4.0, and we need just to scale up our skills as well, reskilling of labor, and many other things that we need to do to correct some of our structural deficits. So I would like to just go around the table with all our panelists here on what some final parting words to the audience, starting with Dato to wrap up the session.
Okay. We welcome, meaning that all the businesses, please come forward, engage the banks, engage us, discuss with us all the issues so that we'll be able to assist one way or another. And then I think for MBSB, ourselves, that we always want to make sure that we proactively engage our existing customers to ensure that they will be able to continue moving forward. So please come forward and engage us as well.
All right. Thanks, Dato. Mr. Fu?
Yeah, I think try to engage with our SME in wherever state you are. If you're in Sabah, SME Sabah, we have a Facebook page. Sometimes we share ideas, information there, so you can get it. If you want to be more active, then you join us. Then we have a members chat group. So we buy from each other, intra group. Somebody want to look for something, they post in the member chat group. I want to buy this. Somebody will respond from the group first. They can't find it, then there are friends who are selling of the members. They will recommend. And I suggest that we don't just hang on to our traditional businesses. While our businesses cannot be done, we have to reassess whether it's going to go forward after the MCO has been uplifted. If not, we should transform to a new business. Start doing it early, get some revenue in the meantime. Thank you.
Thank you. Manwai Kajek?
I think for me, I'm pretty encouraged with the pace of vaccinations that the country is achieving of late. 500,000 doses per day is no small feat, and with this pace of vaccination, I think the economy should be able to open sooner rather than later. And some of the biggest beneficiaries from the reopening of the economy will be the hardest hit sectors that we've seen so far. For example, aviation, hospitality, and also gaming. And I think with regards to Mr. Alex's business homestay, I hope he gets to hang on a bit longer, because I think I see the light at the end of the tunnel, to be honest. And I do see domestic tourism to recover faster, perhaps as early as 2023. But of course, international travel will take longer, maybe by 2024. Trick is to really hold on until the economy can reopen, and and everything
and get
gets
some
back
help from
to
the
pace.
associations. Yes. And the bankers. Yeah. Thank you, Manwai. Kajek?
So I think I can just wrap up. I think I echo Manwai's view that recovery is certainly on the horizon. But I think I also understand how tough it is to actually survive through or weather through these tough times. So I think maybe Mr. Fu's suggestions or Mr. Datuk Nazam's suggestions would be very important, in the sense that I think just try to seek out as many assistance as possible and just try to hang on until we reach that point of normalcy where things will start to get better. Yeah.
Yeah, it's kita jaga kita, right? So we all need to help each other in these tough times. So with that, I would like to end the panel session today. Thank you very much for your time, and I'll pass back the mic to Sakina, please.